Hello and welcome to this IBP for Finance series of videos from GitaCloud. This series is aimed at finance and IBP practitioners. SAP IBP is mostly used to support sales and operations planning processes. Finance runs parallel FP&A processes and other toolsets to develop a full set of financial forecasts, such as budgeted income statement, budgeted balance sheet, and cash flow budget. This results in a fragmented planning landscape, duplication of effort, and inability to run what-if simulations across supply chain and finance during budget iterations. GitaCloud has developed a unified IBP planning model to support both sales and operations planning processes as well as financial planning and analysis processes. We will showcase this model in this IBP for Finance series. The example used here is taken from the book, Accounting for Managers. Let's review the key components of an annual budget. We start with a sales budget. This is equivalent to the consensus demand plan. Sales budget along with desired finished goods inventory levels drives the production budget. This is equivalent to a master production schedule MPS. Production budget then drives the direct materials, direct labor, and manufacturing overhead budgets. This is equivalent to an MRP explosion of the MPS. SG&A and CapEx budgets help complete the budget components in order to then produce a budgeted income statement, budgeted balance sheet, and cash flow budget. We will cover all these budget components and the corresponding financial forecasts in this series. Sales budget is an estimate of unit sales, selling price, and sales revenue in quarterly buckets. We will develop the budget for the year 2022, as if we are doing this in Q4 2021. This will help to later show a budget versus actual variance analysis for the 2022 year. We will develop this example based on a single finished good to keep the calculations simple. Production budget is derived from the sales budget as well as the desired finished goods inventory position. Let's say that we would like to maintain 10% inventory coverage, meaning we should have 10% of next quarter's sales in FG inventory at the end of previous quarter. For example, we plan to sell 48,000 units in Q2. This means we should plan to have 10% of 48,000, which is 4,800 units in inventory at the end of Q1. Note that the desired ending inventory at the end of Q1 is then defaulted as the beginning inventory at start of Q2. Production budget is calculated by adding budgeted unit sales and desired ending inventory, and then subtracting the beginning inventory. Assume we start Q1 2022 with 4,000 units. This leads to a production budget of 40,800 for Q1. Also note we have a quarterly as well as annual view of 2022 budget in the same IBP planning view. Desired ending inventory at the end of Q4 also happens to be the desired ending inventory for all of 2022. We use the last period aggregation LPA function in IBP to automatically default the Q4 value into the 2022 value for desired ending FG inventory, which is 4,400. Beginning inventory for Q1 also happens to be the beginning inventory for 2022 year, which is 4,000. This gives us a production budget of 200,400 units for the entire year. Direct materials are the raw materials or components that directly contribute to producing the finished goods. We have a single raw material for a single finished good to keep this example simple. Assume 2 units of raw material are needed per unit of finished good. We would like to have a 20% inventory cover for raw materials. This means, we should plan to end Q1 with 20% of the RM requirement for Q2. As we need 98,400 units of raw material in Q2, we should plan to end Q1 with 20% of this number, which comes to 19,680 units. Direct material purchase quantity is then calculated by adding production requirement and desired ending RM inventory, then subtracting beginning RM inventory. Assume a cost of $1 per RM unit from our supplier. This helps us convert the RM purchase unit budget to RM purchasing cost budget. Direct labor budget is an estimate of direct labor hours as well as direct labor costs. It takes 0.1 labor hours, 6 minutes, to produce a single FG unit. Let's also assume the average hourly rate in our Asia factory is $13 per hour. This translates to a per FG unit cost of $1.30 for direct labor. GitaCloud has developed a unified planning model in SAP IBP that can take care of both the sales and operations planning processes as well as the financial planning and analysis processes. We covered some of the key components of annual budget in this part 1. This part is sales and operations planning centric and relatively straightforward. We will move to manufacturing overhead, selling, general and administrative SG&A, and capital expenditure CapEx budgets in part 2, which is where we get into the FP&A side of our unified planning model. You can find more such explainer videos at GitaCloud website or GitaCloud YouTube channel. Hope you enjoyed this video. Please like and share if you did. You can also subscribe to GitaCloud YouTube channel. Thanks for watching. Have a great week.